Hi class, today we're going to be looking at Chapter 17, Problem 3B. This is the second video for solvency analysis. So if you'll hold on just a minute, I'm going to share my screen with you. All right, we're working on Chapter 17, Problem 4B. This is the second video where we're going to look at solvency analysis. And what we need to talk about is what solvency is. And solvency is the ability of a company to pay back its long-term debts. So you'll remember in this particular problem, we were analyzing the statements for the Stargell Incorporated Company, and we were comparing the years of 2000 Y1 to 2000 Y2. In this particular problem, we're going to do the analyzation for year 2, and we're going to work on solvency ratios. And there are 3 solvency ratios that we're going to be looking at. The first one we're going to be looking at is what we call the ratio of fixed assets to long-term liabilities. The ratio of fixed assets to long-term liabilities, you would find your amounts on the comparative balance sheet. Again, we're going to be doing this ratio for the year 2000 Y2. So what you have to know is what your fixed assets are. And your fixed assets are your property, your plant, and your equipment. And you can see that the amount of the property, plant, and equipment is $3,740,000. So you're going to take your property, plant, and equipment, which is your fixed assets. You're going to divide them by your long-term liabilities. Now, your liabilities section on the balance sheet covers current liabilities and long-term liabilities. In this ratio, we're just going to be using our long-term liabilities. Long-term liabilities are those liabilities that we intend to pay off for longer than a year. Examples of long-term liabilities are mortgage payable and your bonds payable. Both of these are long-term liabilities. So the total of the long-term liabilities is $1,700,000. We're going to take this figure and divide it into the property, plant, and equipment, and that will give us the ratio of fixed assets to long-term liabilities. So we'll scroll down the page here till we get to the number 8 ratio, which is the ratio of fixed assets to long-term liabilities. And for this year, it was 2.2 times is the ratio of fixed assets to long-term liabilities. What you would want to do is you would want to compare this with what you got for the last year. They did not ask you to do the ratios for 2001, but if you had, you would find that this ratio has actually gone is actually about the same, but it has actually gone down from the previous year to this year. And you might want to take a look at your fixed assets to see if they increased or decreased from the last year, and your long-term liabilities. So if we go back to the balance sheet and we look at our fixed assets are our property, plant, and equipment. You can see that in year 2001, we had less fixed assets than we do in 2002. We could also look at our long-term liabilities, and you can see that the long-term liabilities for year one is less than what they were in year two. So there was a difference between years 1 and 2, but there wasn't that much of a difference. And what you would have to take into consideration is that you have a little bit more of a liability to pay back for your mortgage. Obviously, you didn't have any mortgage in 2001, but in 2002, you have a mortgage note payable. So I'm assuming that they bought or purchased a building, which would show up in your property, plant, and equipment. But what they wanted you to do is just calculate the ratio for 2000 Y2. And in that ratio, you're going to get 2.2 as the amount of the ratio of fixed assets to long-term liabilities. And this measure tells you if you have enough fixed assets to support your long-term debt, and it's considered to be a solvency measure. And solvency, again, is the ability to pay back long-term debt. You might remember yesterday when we talked about liquidity ratios, that was the liability, or the previous video where we talked about liquidity ratios. And liquidity ratios is the ability to pay back short-term debt. In this video, we're looking at the ability to pay back the long-term debt. Another solvency ratio that we can use to see how well we're doing at paying back our long-term debt is what we call the ratio of liabilities to stockholders' equity. And what you're going to do with this ratio is you're going to divide your total liabilities by the total stockholders' equity. Again, you would be analyzing the balance sheet where you find this information. And so if you want to, when we click on this, it shows you the addresses of the items that we use in preparing the ratio of liabilities to stockholders' equity. So your total liabilities is found in cell address B67, and we're dividing that by cell address B73. Cell address B73 is your total stockholders' equity. So if I go back up the page to those cell addresses, you can see that B67 is our total liabilities. We're going to divide our total liabilities by our total stockholders' equity. And what that does is it gives you a ratio of liabilities to stockholders' equity of 0.4. And this is a rounded amount. It's actually 3.6. And so they rounded it up to 0.4. So the ratios of liabilities to stockholders' equity is going to measure how much of the company is financed by debt and how much the company is financed by equity. And again, this is a solvency measure. It is used to determine whether a company can pay back its long-term debt. So if you want to look at the total liabilities, you'd really want to look at what happened in 2001 and compare it to 2002. As you can see here, your total liabilities increased in 2002. And so that would have a bearing on the ratio of liabilities to stockholders' equity. You also would want to compare what happened with your total stockholders' equity. And you might even want to go back further and look at each one of the stockholders' equity accounts to see if there was much of a change. As you can see here, your preferred stock and your common stock stayed basically the same throughout this period of time, but your retained earnings grew. And if you wanted to look at that further, you could look at your retained earnings statement that they had given to you. And you can see here that your net income for 2000 Y1 was $925,000, but the net income in 2000 Y2 went down to $900,000. And so that would have a bearing on your total retained earnings, because basically you gave out the same stock dividends that you did last year. That really hadn't changed. So the amount of net income went down. So there might be a little bit of a problem in you paying back your long-term liabilities. But the truth of the matter is, with this company, it didn't change that much from year 1 to year 2. And so when we look at this ratio, if you had calculated what happened in year 1 and compared it to year 2, you wouldn't see that there was that much of a difference. But there is a little bit of a difference showing that your company wasn't as strong as it was before to pay back the long-term liabilities. And so this is important that you know what the ratios mean and how it affects the company. The last ratio that we're going to look at is what we call times interest earned. It too is a solvency ratio. And to find the times interest earned, what you need to know is the sum of the income before income taxes. Plus, you're going to add to it the interest expense. And then you're going to divide that total by the interest expense. In 2002, we get 7.6 times that this company would be able to pay back its interest expense. So the times interest earned is really telling you how well a company can make interest payments toward its long-term debt. And this company's times interest earned is 7.6 times. Of course, you would want to compare that with what happened in 2001, but they didn't ask us to do that in this problem to see if there was a difference. So if we look at how you figure times interest earned, we need to start with our income statement, where we will find the income before income tax. So I'm going to scroll back up to the top where we have the comparative income statement. The income before income tax is on line 39. So we're going to take the income before income tax, which was $1,130,000. We're going to add back our interest expense, which was $170,000. And when we get that total, we're going to divide it by the interest expense of $170,000. So that will give us the number of times the interest has been earned. You would want to compare that with what happened in the last period of time. And you can see your income before income tax was a little bit higher in 2001 because our net income was higher, but our interest expense was a little bit lower because we didn't have that mortgage payment that we needed to make in year 2 because we bought another building. So you'd want to compare the 2 years to see whether the times interest earned went up or it went down. In this case, we really can't tell because we only did 1 year's figures, but you would do both of them and compare the two to see about the company's ability to pay back their interest. And I believe because the amount of the interest increased, that the times interest earned would go up in year 2. So we have a little bit of a lesser chance of the company paying back the interest than it had before. So these are the 3 solvency measures, and those are the only ones that I want to talk to you about in this video, which is video 2 for solvency measures or analyzing solvency. So I'm going to stop sharing my screen with you, and I'll see you again next time. Bye-bye.